A very good morning, ladies and gentlemen. Please rise for the oil lamp lighting ceremony. To ceremoniously commence today's proceedings, I kindly invite the following dignitaries to light the oil lamp. Dr. Indrajit Kumaraswamy, Governor, Central Bank of Sri Lanka. Mr. Anura Disanayaka, Secretary to the Ministry of Mahaweli Development and Environment. Dr. R.H.S. Samaratunga, Secretary to the Ministry of Finance. Mr. Pawan Sukhdev, United Nations Goodwill Ambassador. Dr. P.N. Veerasinghe, Deputy Governor, Central Bank of Sri Lanka. Mr. K.D. Ranasinghe, Deputy Governor of Central Bank of Sri Lanka. Mr. Satya Tripathi, Global Lead on Sustainability, United Nations Environment Programme. Ms. Una Macaulay, United Nations Resident Coordinator and UNDP Resident Representative. And Mr. Mano Titavala, Senior Advisor to the Ministry of Finance. And Dr. P.N. Veerasinghe, Deputy Governor, Central Bank of Sri Lanka. Thank you, dignitaries, and we kindly request everyone to please rise again for the national anthem. Thank you, everyone. Once again, I take immense pleasure in welcoming everyone to the National Workshop on Establishing Green Accounting System for Sri Lanka. Recognizing the importance of creating harmony and balance between economic development and environmental sustainability, we are gathered here today to achieve a milestone in integrating environmental considerations into the economic development planning process. A country's GDP is the estimate of total values of goods and services they produce. But even when the concept was first developed back late in the 1930s, the man behind it, Simon Kuznets, cautioned that it wouldn't tell the complete story of the welfare and the well-being people in the country. Distinguished guests, ladies and gentlemen, today's reinvented economic landscape, changed climate, and advanced technology calls for a measurement of growth that addresses these concerns. Many initiatives are already underway in Sri Lanka to establish a system of environmental economic accounting, popularly known as green accounting, as we understand that economic development and climate actions are not competing goals but common ambitions. We believe this workshop and the sessions ahead will create plenty of opportunities and provide a platform to share the knowledge and highlight possible avenues for the way forward to formulate a truly multi-stakeholder set of policy recommendations. To kick off this workshop, now I kindly invite Secretary to the Ministry of Mahaweli Development and Environment, Mr. Anura Disanayaka, to deliver the opening remarks on the National Steering Committee for Green Accounting.
Dr. Njidit Kumaraswamy, the Governor of Central Bank of Sri Lanka, Dr. Pawan Sakudev, the United Nations Environment Program, and distinguished invitees, ladies and gentlemen, good morning. It gives me a great pleasure to welcome you all at this important workshop on importance of establishing green accounting system for Sri Lanka, jointly organized by the Central Bank of Sri Lanka, Ministry of Mahaweli Development and Environment, the Blue Green Economy Financing Facility of the United Nations Environment Program, Department of Census and Statistics, and the Institute of Policy Studies of Sri Lanka. We are pleased to have an eminent scholar, Dr. Pawan Sakudev of United Nations Environment Program, as our keynote speaker, and I would like to extend my appreciation to you for joining us today, despite your busy international schedule, sir. Sri Lanka is facing the challenge of achieving economic development goals while maintaining environmental sustainability. We are a signatory of the Paris Climate Agreement of 2015 and committed to achieve sustainable development goals by 2030. The greening of the economy was considered the optimal path to achieve an inclusive, prosperous, and sustainable future, which is adopted by Sri Lanka in 2016. In this respect, a clear national need had arisen for sustainable path of economic development through internalizing environmental externalities. However, the environmental aspects are not adequately incorporated into conventional system of national accounts, which plays a key role in formulating economic policies in the country. The UN Department of Statistics, in collaboration with a number of other international agencies, introduced the system of environmental and economic accounting, which is popularly known as green accounting. Ministry of Environment has initiated green accounting as early as 1990s. In 2007, Ministry of Environment and Natural Resources then initiated a green accounting framework of Sri Lanka with the collaboration of other relevant government agencies. A standing national committee for establishment of green account system has been established within the ministry, which is comprised of members of key national agencies. Several sectors have been identified for green accounting, including forest, water, minerals, land, and industry. A comprehensive accounting exercise was carried out for the forest sector in 2012. As we all know, forests provide a wide variety of values for an economy. However, the present national account system only recognizes few benefits, mainly timber and the limited amount of forest products that directly enters into the market. Therefore, it is essential that all values are identified, valued, and incorporated into a system of environmental accounting system in order to reflect the true contribution of forests and enable the correct level of investment for the sector. Establishment of a green accounting system is a significant undertaking that needs necessary resources, knowledge, and the technical skills, institutional cooperation, as well as political backing. Credibility of information generated by the system is of utmost importance, and it depends largely on the implementation mechanism involved. Identifying and measuring values of ecological resources and estimating damage costs on the environment are not straightforward process, as most of these are non-marketable. The green accounting systems for Sri Lanka should include multiple stakeholders. These are essential as the management responsibility of different environment resources are scattered among a number of agencies in different ministries. As a key stakeholder, the Ministry of Mahavala Development and Environment, along with agencies coming under it, is expected to play a coordinating role to receive the support from other agencies. The Department of Census and Statistics also has to play a key role in this connection. As a mandate holder of producing national accounts of the country, the census department is responsible. Green accounting system can be helpful in establishing a comprehensive data gathering network for collection, compiling, and analysis of this wealth of environmental information. Despite the massive challenges, establishing reliable accounting for green accounting would open up numerous opportunities to reach the goals of sustainable development in Sri Lanka. Recognizing this opportunity, as a further step towards facilitating this process, the Blue-Green Economic Financing Facility Secretariat of the United Nations Environment Programme, with the partnership of Central Bank of Sri Lanka, the Ministry of Mahavala Development and Environment, the Department of Census and Statistics, and the Institute of Policy Studies of Sri Lanka have come forward to organize this national workshop to develop green accounting system for our country. I presume the major aims of these workshops are multifold, such as carrying out a stock taking on previous attempts and assess the present situation of ongoing activities. Identify gaps and challenges for continuation and further development of green accounting system in Sri Lanka. Thirdly, learning from experiences of other countries in implementing green accounting systems. Fourth, identify necessary actions to create an official mandate and raise financial and other necessary resources for the implementation of green accounting system in our country. This workshop brings together researchers, policymakers, and academia working on a common platform related to green economy, sustainable development and environment, and green accounting. The workshop should share lessons learned from past efforts and to consult the stakeholders' views on future developments. I also emphasize that this workshop should be interactive and participatory. It is expected that participants will jointly assess the situation of green accounting efforts in Sri Lanka and global experience on the subject and develop a roadmap for establishing a green accounting system for our country. I also wish to mention that here in Sri Lanka, the top priority has coded on environment, as His Excellency the President himself is the minister in charge of the subject. Ladies and gentlemen, I believe this workshop will facilitate a dialogue not only on green accounting but also on the key aspects of developing green economy in Sri Lanka. I believe that the findings and recommendations of this important workshop will provide valuable insights for policymakers and all stakeholders for establishing and developing a viable mechanism for producing green national accounts in our country. Finally, I welcome all you once again to this important national workshop on green accounting. I hope all will have productive 2 days of deliberations and outcomes of this workshop be utilized successfully by relevant parties. My best wishes for the success of this workshop. I thank you.
Thank you, Mr. Dissanayaka. Now I have the pleasure of inviting our keynote speaker today. An environmental economist, he advocates the importance of governments and businesses' need to understand our ecosystem, biodiversity, and natural resources that are the backbone of our economies, and insists that their value should be integrated into the decision-making. Ladies and gentlemen, please join me in welcoming the United Nations Goodwill Ambassador, Mr. Pawan Sukhdev.
Respected Governor, Deputy Governors, Secretary, senior colleagues, ladies and gentlemen. It is a particular honor and a pleasure for me to be here. As some of you may know, I spent most of my life not as an environmental economist, but as a banker, and had several interactions on many committees with the Reserve Bank of India, among others, and later with the Bank of England. I'm delighted to be with people from what I would still call my world, even though I see myself more as an environmental economist these days. Today, I wish to talk you through some of the background and some of the challenges that are faced by countries as they engage the process of green accounting. Today, I also want to cover with you very quickly some of the work that has been done by colleagues at the United Nations Environment Programme, but also by very senior and well-known economists such as Professor Partha Dasgupta on the concept of inclusive wealth, which I see very much as a stepping stone towards green accounting. It is, if you like, if you compare it to the business world, it is to the business world what a management information system is compared to the final balance sheet and P&L. And then I wish to close with some thoughts on some of the related policy challenges and areas that will be affected as you progress towards your own system of inclusive wealth and green accounts. So the title of my conversation with you is Measuring Sustainable Development, the Importance of Green Accounting for Moving Beyond GDP. It is interesting that so many years since the concept of sustainable development began to be taken seriously, 1984 onwards, that it is more than 30 years and we still don't have a system formally in place for countries who are involved in the process of transitioning their economies and seeking the goals, the SDGs of sustainable development. We still don't have a means of measuring sustainable development. As a young banker, I was brought up by my seniors to think that you cannot manage what you do not measure. And they, in ANZ Bank and then in Deutsche, made this very clear, but I find that in most countries, in fact, I would say to this day in all countries, we still are not fortunate to have a system to measure what we plan to manage, which is sustainable development in our respective countries. This is the challenge. And of course, voices presenting this challenge and asking for something to be done are getting more and more mainstream. Literally a few days back, on the 14th of August, I came across this headline in The Guardian, an English newspaper that I read, which is talking about our subject, which is the challenge of GDP in the context here of the UK. And I was reminded of the emphasis that was given to this very subject at the last Davos meeting in last year and immediately afterwards in April in 2016, where they actually had a session on 5 measures of national performance, which in their opinion were better than GDP. This thinking is supported by political economists, and I'll just read you one quotation. Someone wrote, because national accounts are based on financial transactions, they account nothing for nature, to which we don't owe anything in terms of payments, but to which we owe everything in terms of livelihood. A nice way of expressing this thought, but the sad thing is that this thought is from the political economist Bertrand de Jouvenel, a Frenchman who said this in 1968. Friends, we are now 50 years since then, and we are still working on this, and I think we need to accelerate. Indeed, not just political economists and environmental economists like myself, but even the very founders of the system of national accounts, James Mead and Richard Stone, 1953. This is what one of them, Richard Stone, said in his own Nobel Memorial Lecture in 1984, when he'd had the benefit of hindsight. He said that the 3 pillars on which the analysis of society ought to rest are studies of economic, socio-demographic, and environmental phenomena. And among other things, he said that environmental issues such as pollution, land use, and non-renewable resources offer plenty of scope for accounting. So this, again, is 30 years ago. He's saying that there's plenty of scope for accounting, but we are still not doing so. And again, this, whilst I empathize with Sri Lanka's challenge, I visit many countries, and I find this to be a familiar story. So it is not just an issue in your country. I think if I were to think of a political event with political backing that escalated the matter, I would probably find many, but the one that struck me most was this meeting in Brussels in 2007, which was termed Beyond GDP, hence my use of the term Beyond GDP. This is a large meeting, and that's a picture from the main hall at the EU Commission. 650 delegates, including politicians, scholars, institutions, private sector, from over 50 countries, and all of them supported this concept of moving beyond GDP as the main measure of national performance, and GDP growth as the main growth metric to be looked at. And this was the summary statement that they issued, all of these, which is that GDP is unfit to reflect many of today's challenges, such as climate change, public health, education, and the environment. And at this point, I will say that when we say green accounting, I think all of us, when we're looking at it from an environmental perspective, sometimes may forget that actually the broad concept of green accounting is to address all of the above. It's not only about the environment, it's also about reflecting the invisible impacts and the externalities on human capital, on social capital, and of course on natural capital. So we have, without the right lens, without having the means of measuring what we manage, we clearly have a big navigation challenge, which is that we are in this space of three capitals, of physical capital, of human capital, and of natural capital. And I will touch upon each of these in my remarks this morning. And we are trying to navigate this complex three-dimensional space with something that is equivalent to a mariner's compass. Imagine trying to run a spaceship with the mariner's compass. And that's the challenge that we are facing. And it's, if we haven't had an accident, then we should thank the Almighty for His benevolence in guiding us to a point where we can move. But I think the good news is that, of course, as you are involved in, and as we all know, there are good ways forward, at least two, which I will dwell upon this morning. One is, of course, measuring GDP, and the other, which is a parallel and useful way of looking at it, is also measuring inclusive wealth. When we measure green GDP, what we do is effectively provide different adjustments for GDP, for accounting for the invisible incomes that nature provides, most of which are not marketed anyway, and equally also to account for some of the depreciation that takes place, because by and large, we are losing stocks of natural capital around the world. At the same time, there is progress. People are wealthier, they are earning more. Human capital, knowledge, skills, and the capacity to earn is increasing. And this is thanks to investment in education and skills training. And even this is not formally recognized in accounts. So we tend to take investments in schooling and universities and building as part of GDP, but these are not expenses, they are actually investments. And they are generating changes in the minds of young people, enabling them to succeed and to earn more. And that change in capacity as they educate, as they train, is actually adding to their human capital, but we don't account for that either. So there is not just a depreciation in natural capital, which is invisible to our systems, but there is also appreciation of human capital, which is also invisible in our systems. So we have a double whammy of deficiencies here, which we have to address. And green accounting and green GDP as a metric and as a signal metric of green accounting does tend to take care of that. The rationale is that we need to capture and integrate into national accounting systems all significant, all material externalities, as we call it, which are not reflected in traditional GDP accounts drawn up under the SNA. If this is the accounting system, if you like, the new balance sheet and new P&L of the country, then the question is, what's the new MIS? What's the new management information system? And that, to me, is what is being called inclusive wealth. And as a measure of performance, I think this is very clean and very intellectually appealing because it is measuring stocks. Wealth, finally, is a stock. Wealth is the availability of human capital, of social capital, relationships, of physical capital, which we all create and work for, and of natural capital, which underlies everything. The average availability of that and the access to that to the individual in a country is a signal of wealth. Per capita wealth, if it were measured, should be measured like that. And this is what the inclusive wealth system actually does. It measures the manufactured and financial assets, called physical capital, but also natural capital, which includes, by the way, what we call abiotic resources like oil and minerals, but of course also biotic resources as minerals, forests, fresh water, and so on. And it measures human capital, knowledge and skills. And even though there is an aspiration to measure social capital, mostly this has not been done for the simple reason that incomes are generated by physical, human, and natural capitals. Social capital is a binding force. It is that means of ensuring that the other three capitals generate incomes. If you didn't have social capital, if you didn't have rules and institutions and law and order and a constitution, then even business would not function. You would not be able to honor contracts. You would not be able to deliver or settle anything. I mean, imagine a financial system without social capital, without rules for the marketplace, without a behavioral understanding of what is a market maker's role, or what is a central bank's role, or what is a banker's role. These are all elements of, in the private context, social capital, without which, of course, the system would not work. It's not the social capital that delivers the income, but it enables the others as an enabling capital to deliver incomes. So these are some of the concepts that are ingrained in the metric called inclusive wealth. And please note that when both these approaches, green GDP as well as inclusive wealth, speak about stock, they refer to the exact same thing. So it is not that you have to duplicate effort to generate one before you can start generating the other. In fact, the same process should be able to deliver one and then the other, inclusive wealth, and then finally your actual accounts. There's a long history to these alternative systems, which is tied up to different growth models. Now, the conventional growth model that we have today in terms of what is the purpose of our economic policies is tied into and is measured through performance on the GDP front. But equally, there are other growth models led by many senior economists and many distinguished institutions, which I will mention briefly. The inclusive wealth approach was pioneered by the late Professor Ken Arrow and Professor Partha Dasgupta and Professor Carl-Johan Mailer. I never met Professor Arrow, but I know both the other two, and I consider them my gurus. I've read many of their works, and I rely a lot, even today, on their advice. And they pioneered this concept of inclusive wealth way back through many papers, in fact. I think 2003 was a seminal paper, but they have been working on it from before that. Around 2005, UN SCAP came up with what was referred to as the green growth model, the idea that you could target not just GDP growth, but environmentally friendly GDP growth. In other words, growth that is still GDP growth and measured thus, but does not result in such severe impacts on the natural environment. And finally, the French government commissioned a study by Professors Stiglitz, Sen, and Fitoussi, which was basically titled Comprehensive Wealth. This was in 2009. Critics of this study will say that it was commissioned because, French GDP had stopped growing, and they wanted to build in enjoyment and social factors into their understanding of what is a good economy. But I think these are light criticisms. The reality is that the French government and the president himself and others in France had been talking about this topic for decades, and I guess they were keen to move ahead. And yes, it definitely did show that there are other dimensions of performance, social performance. Why call it comprehensive wealth? I did ask some of the people involved, and they could have called it inclusive wealth because all the assumptions and all the framework propositions are the same as inclusive wealth. But what had happened is that over time, the term inclusive was being used to refer to something that's socially inclusive. So there was a degree of confusion created outside, not obviously with the economists, but outside, as to what does this mean, inclusive wealth? Is this about better distribution of incomes to the poor? No, it is not. It is about including all capitals in your assessment. So there was a degree of confusion, unfortunately, created by the use of the term inclusive, even without intending to. And therefore, the group, I believe, chose the term comprehensive wealth, whilst meaning more or less the same thing that we mean by inclusive wealth. The work of Stiglitz, Sen, and Fitoussi did not go as far on natural capital as perhaps I would have liked it to, because they felt that there wasn't enough available information, market information on natural capital. And yet I found that objection a bit strange, because we all know that most of what natural capital provides in the form of ecosystem services actually is in the nature of public goods. So there's no reason why you should try and find it in markets. And that's something that we all, a challenge that we all face, and that's the whole purpose of green accounting. A few words about inclusive wealth, and this is, there is a beautiful foreword, and the report looks like that. I have forgotten to bring my copy. I wanted to bring it, but it's a beautiful foreword by Professor Dasgupta, and it, I think, summarizes in the most simple, elegant language about what is inclusive wealth. It's the social value of an economy's capital assets. These comprise manufactured capital, roads, buildings, machines, equipment, human capital, that is skills, education, and health, and natural capital, subsoil resources, ecosystems, the atmosphere. He then talks about social capital, and here's how he expresses it. Such other durable assets as knowledge and institutions, culture and religion, more broadly social capital, are taken to be enabling assets. That is, assets that enable the production and allocation of assets in the other three categories. The effectiveness of enabling assets in a country gets reflected in the shadow prices of assets in the first three categories, which means physical capital, human capital, and natural capital. The idea and the thinking behind inclusive wealth seems to have taken a life of its own now, because even The Economist published this table, which I'm showing you today, which is about inclusive wealth in a number of countries, including Japan, USA, Canada, and so on. And they're just taken a random selection of countries, but it's interesting to see how a country like Japan tops the inclusive wealth score, because the significant amount of human capital per capita, even though they don't have much nature left. And another country like Canada does quite well because it has significant natural assets, both mineral as well as ecological assets. And another country like Australia does quite well, even though it has low human capital and low physical capital, but significant natural capital, and so on. And these are, of course, all per capita that we are talking about, per person. So you might wonder, what does this, if this is the MIS, the Management Information System, how does this look like compared to our GDP metrics? Well, here are some numbers taken from the Inclusive Wealth Report that I just mentioned of the United Nations University and the United Nations Environment Program. So if we just look at the top picture, you will see that there are 124 out of the 140 countries which experience positive growth. Anything that's colored green, basically. Green or dark gray is basically positive. Green or light gray is positive. Dark grays are negative. So 124 out of 140 had positive GDP growth rates. But if we look at inclusive wealth as the metric instead, then we'll find that only 86 out of 140 countries which have been studied had positive changes in inclusive wealth. And furthermore, if we make adjustments for climate change impacts and increases in oil prices, which have affected some of those GDP statistics, and total factor productivity, then the adjusted number of countries, the adjusted inclusive wealth index, which is one of the MIS that is produced, in fact, is only 58 countries out of 140 have delivered genuine progress, as in a genuine increase in adjusted inclusive wealth per capita. So this is the challenge. The lens of GDP can create the appearance of progress, whereas in fact the wealth on average of individuals and their access to assets is not in fact improving. So real improvement is not happening, even though GDP is telling us another story. That's the challenge. And I think this challenge and the numbers behind it, and literally country by country by country, to see this is startling. I mean, even for me, even though I've been involved in this, to actually see it in black and white or green and white, that is quite an experience. Expressed not in country terms, but overall, here are the charts, and they tell the same story. So if we look at the last 2 decades, this is taken from the 2014 report. By the way, in a couple of months, you will have the 2017 report. I do have some data later on taken from there. So in October, they will produce the next report. So if we look at GDP growth over this 2 decades, we are looking at a growth of almost 50% over that period. But if we rework that in terms of inclusive wealth, then the term being used for it is anemic. It's only 6% over that period. And that is not good news. Just as in green accounting, which looks at both land areas, agricultural land and pasture land, and looks at mineral resources, so also does inclusive wealth. So you will find, as I said, the MIS that we are talking about here does achieve quite a lot of what you need in terms of the picture from the national accounting or from the policymaker's point of view. These are, for instance, the changes in cropland wealth per capita based on land areas turned to agriculture and the production functions of different key crops in those areas and what they look like. And you can see that there are some countries here, for instance, Argentina and Bolivia, which will show significant increase in cropland. But on the flip side, when we look at their national and inclusive wealth statistics, they don't really show an increase because they are actually converting converting grassland in one case and forest in the other case into pastures and agricultural land. But there are other countries like Vietnam, which interestingly and surprisingly show a positive increase on both, so suggesting that it is actually possible to have a win-win situation. So it clearly is a reflection of national policies, and there's no one-size-fits-all or no single rule that you can derive from this, but you can see the differences. As I mentioned, inclusive wealth, just like green accounting, does take into account capital assets, which are subsoil assets, including, therefore, oil wealth per capita. So here is an image of what that looks like in terms of how the oil wealth per capita is changing. You will note that all the numbers are negative, and that's no surprise because we are drawing oil out of the soil. So therefore, our reserves have therefore gone down. But obviously, the flip side of that is that the value addition of the oil business is counted for and accounted for in GDP. But this is the challenge, right? So because we are accounting for the value addition on the extraction and sale, but not accounting for the change in stock that has happened as a result. So clearly in this image, you are seeing that accounting taking place as well. And this is based on fairly detailed estimates of reserves to production. These are some examples on coal, natural gas, and crude oil, the basis of the assumptions and the modeling that is built into the inclusive wealth statistics, reserves to production, remaining extract years of fossil fuels. I now come to human capital, because as I mentioned, green accounting and inclusive wealth are not only about natural capital, even though that is clearly where the name comes from. And the concern was initially from the point of view of how do we address the problem of not including natural capital impacts. It includes all capital, it's inclusive. So it's about human and social as well. How do we view this picture? Now here is a diagram which, again, to me, seeing it in black and white was a shock and an education as well, even though I was intuitively aware of this, is that you see the colors here, the high-income countries clustered in as black dots. The x-axis here is natural capital per head, and the y-axis is human capital per head. And you'll see that there's a kind of scatter diagram, and you'll find very few black dots on the right-hand side, which have got low human capital and high natural capital. And the ones that you can see at the far end are basically Canada and Australia, because we know that they have, and you all know that they have high natural assets. And then you have a few upper middle income countries, but you will find this huge concentration of the higher income and the upper middle income countries in that box, in that corner circle that I've outlined, where almost 60, if you look at it visually, 60 to 80% of the total capital of that country is basically human capital. And what this is saying to you, which we all know, is that this is where development is achieved. It is about adding value to the human mind, to the human skill, which enables higher incomes to develop over time, which enables layers and levels of development to happen. But at the same time, not destroying the base of that development, which is natural capital. And this is the challenge that we all face. And this is the path of development. When we look at sustainable development, there are two trajectories. For the developed world, it's about reducing your footprint. For the developing world, it is actually green development, which is to achieve higher human development, achieve higher HDI, whilst not increasing our per capita footprint, ecological footprint. So the challenge is well laid out, and I think this is where policy needs to head us in. Excuse me. We need to evolve policies whilst we defend natural capital and make it available for the poor who need it the most. Make sure that access is well protected. At the same time, we need to develop other human capacities, education, health, training, provide alternative livelihoods, and provide the means of aggregating human capital so that you have pools of human capital which become internationally competitive. Whether we like it or not, we are in an international marketplace in almost any service, any good that you want. And countries and economies which achieve competitiveness in a particular segment or in a particular sector, who are the ones who succeed? Whether it is Singapore's recent, I should say, the last 15 years, and I was seeing this as I was a banker, their investment in mutual funds and their changes in their own tax legislation, sir, to make it attractive to run the mutual fund business out of Singapore as a an entrepreneur, financial entrepreneur of sorts, and their desire to attract, and I'm sure Sri Lankans have migrated to Singapore, and this is the reason, because of this strong investment by the country to create an Eastern Switzerland of sorts, an Eastern mutual fund empire, and they've done it. It is the case. I mean, most of the mutual funds and the asset management business in our hemisphere is basically there. Equally, India over time has created an IT backbone, which is outstanding by any standards. And that, again, is investing in human capital, largely in-house, ingrown, as in within the Indian country. So we have examples of success stories of human capital being developed to create critical mass in particular spheres, in particular competencies. And that generates a huge spur for development. And in both these cases, that has not happened at the expense of natural capital. It is therefore the right kind of human capital development, which does not exploit unnecessarily or exploit in a careless way the natural capital resource that is available to the nation. This brings us to the richness of the debate around human capital, which is coming up not just at the policy level nationally, but also in the world of business. I will be addressing this point from the business perspective in a session this afternoon at 3:30, where I also address sustainable development goals. I know all of you as bankers are familiar with, and central bankers are familiar with this, but maybe the world of business is not that familiar, so I will spend a few more minutes this afternoon on that topic. But I will be delivering in a different way the same message, that investing in human capital has huge benefits, and we are talking about investing in terms of not only education and training, but holistically, including parenting and early education and healthcare, and ensuring that the human being is able to be mobile, is able to be healthy, is able to be educated and skilled in order to deliver higher incomes and over time achieve development, and to provide national policy frameworks which build particular pools of competency, build critical mass in particular areas so that achievement of competitiveness is possible. So what tends to develop is knowledge, skills, and competencies and attributes which are there, but also health. And this has benefits across a whole span, which is economic, personal, and social. And it leads to improvements in market and non-market activities, in healthcare, in well-being, and of course in the knowledge and willingness to cooperate, which in fact leads into social capital. The better educated the electorate and the citizen, the more social capital is likely to grow because of the ability to cooperate and understand public purpose. So when we ask the question, let's take a look at where investment in education is actually highest. Even this is available through the Inclusive Wealth Statistics that have been published in 2012 and 14. And you'll find some interesting answers that some developing countries are taking this seriously. Chile is a well-known case. It was actually studied by the World Bank as well. It's a clear case where human capital investment was very strong. But equally Mexico, Turkey, Afghanistan. I mean, so there are some interesting and very heartwarming positive stories on human capital development. And I close this commentary on inclusive wealth and its use as a management information system, almost as a precursor to green national accounting, to ask, what does South Asia look like? So these are the latest results, which will be there in the 2017 as well. To avoid the sort of volatility in annual statistics, they have taken 5-year cuts as of now, and they've shown how inclusive wealth has changed in South Asian countries, including India, Sri Lanka, Pakistan, Bangladesh, etc. Over the last 4 decades, 90 to 95, 95 to 2000, 2000 to 2005, and 2005 to 2010. So these are all 5-year decadal changes with respect to 1990. So these are cumulative numbers that you can see out there. Not surprising that even though Sri Lanka has lost natural capital, but clearly there has been an improvement in human capital, which has then overall, on average, increased what we call inclusive wealth for the country. So with these thoughts, I now move to the next topic, which is measuring of GDP. Now, I did define what is GDP, so I won't repeat what it is in terms of what are adjusted GDPs and the rationale, but point out that it is about valuing the non-market services, the environmental assets. It is about calculating the real value of education and skills, not merely the money spent on education and teachers' salaries, but the investment in human minds and skills that results in higher salaries for them in future and present valuing that. So it's calculating that. And it's also present valuing liabilities. There are pollution costs which will create, there are pollution impacts today which will create health costs tomorrow. We need to start accounting for that because we've created the impact today that will cause the problem and the GDP costs tomorrow. We use numerous economic modeling techniques in the process of measuring green GDP. Some of you are from the national accounts side and are working on this, are fully aware of that. The total economic value framework is used by some. And typically, these adjustments can and are calculated on an annual basis. And another point to bear in mind is that there are both stock adjustments as well as flow adjustments. There is appreciation and depreciation of stocks, and at the same time, there are unaccounted flows. So when one is presenting, and I'll give you an example in a moment, when one is presenting, one must be careful not to net off, because there is sometimes this unhealthy tendency to present net numbers, which I don't like, because they disguise more than they reveal. And the power of this is to reveal, where there's no point diminishing your own powers in this. And finally, the important and concluding message I would give with the whole area of preparing green GDP, as indeed with inclusive wealth, is that it must focus on policy analysis. You cannot be policy prescriptive. This is about accounting, but you can be policy informative, and you can prepare information in a manner that enables policymakers to make choices which perhaps in some cases their gut tells them to make, but they need some evidence, they need some hard evidence, and then your accounting or your MIS is providing them that evidence. And that, I think, is where it really is very satisfying when, for any of us as national accountants or as economists, we find numbers being of value to policymakers. So these are the things that can be done with the results of our work, which is assessing whether economic growth in a country or in a province has been at the expense of its asset base, understanding trade-offs that we have made over time for evaluating conflicting land use alternatives, supporting or updating any existing natural resource policies in the country, supporting changes in land use planning and zoning restrictions and so on, updating resource use fees which may be charged for access to land, access to water, implementing PES systems, payments for ecosystem services, where an idea may be there, but you don't have the numbers yet as what kind of pricing do you apply, so it can help you do that as well. And finally, improving the financing for environmental and natural resource management, because very often we may have policies for protected areas, we may have policy for restricted areas, but we may not necessarily see the economic value of that restriction and that conservation zone. And the green accounting approach, after changing the assumptions, because green accounting sometimes takes the most conservative assumption, which means that level of assumption over a range, which will give the smallest change to GDP. But when your purpose of valuation is different, which is setting up a payments for ecosystem services, then you are trying to be more fair. You're not trying to be conservative, you're trying to be fair. Then you will change that assumption. You might use the middle of the range and not the most conservative. So I had this personal experience, actually. We had done some green accounting calculations in my home country many years ago, and I found someone was using them for PES. I said, who asked you to do that? That was not the assumption for which I wrote these accounts. And then we sat down and had a good discussion as to how to change that. I come to that example, I'd just like to share some of my own learnings from that and subsequent work that my team and I have done at various intervals during my UN days on green accounting. And this is a project which, since I know many of you have been involved in Sri Lanka on the forest side, I thought I'd pick the forest monographs that we wrote and see what lessons we drew from those forest monographs. We also had monographs on freshwater, on agriculture, and on education. All very interesting, but these are comments specifically on the forest monographs, which looked at timber, fuel, and non-timber forest products and carbon sequestration values of the forest. A separate one which looked at the bioprospecting, ecotourism, and also non-use values of the forest. And a third one which looked at 3 forms of ecosystem regulating services: augmenting water resources, mitigating soil erosion, and mitigating flood damage. So here's the physical accounting framework that was used for the forest accounting framework. Opening stocks, changes due to various economic activities, be it logging or encroachment or shifting cultivation, then changes such as afforestation, then losses due to livestock and so on, and other accumulations and natural growth estimates and so on, and net changes of land, other volume changes, basically ending up with closing stocks. In this framework, we separately accounted for area accounts, then went from the area accounts. So there are three tiers of satellite accounts that we looked at, we created. One was area level, one was the physical level in terms of timber and carbon. We worked on the simplifying assumption, and it was a simplifying and clear assumption, that timber was the main output from non-protected areas, and that it was absent from protected areas. Now, anyone who understands protected area management in developing countries knows this cannot be true, but it's a simplifying assumption. So we worked on the basis that we account only for carbon values in protected areas, and we account only for non-carbon values in non-protected areas, which means timber values. And I quote this experience because it was challenged, and then finally people liked it because they said, yeah, it makes it clear. And we know the reality is not exactly this, but at least it makes it clear what you're doing, which is good. And then from these physical accounts, we then translated using our various valuation techniques into monetary accounts. Now, some of you will in the afternoon session, later morning sessions and tomorrow's sessions bring up the data challenges. And all I can say is that it is the case. There are always data challenges. And here are some of the data challenges that we faced. Apart from paucity of data, we just had to rely on many different sources. So we took data from the State of the Forest Reports 2001, from the Indian Chamber of Forest Research and Education, from ICFRE, from the Forest Survey of India 2003 estimates for the closing stocks. There was really a range of sources. Whilst all government sources, we had to be careful to reconcile them because not all government sources are based on the same data collection exercise. So even land use areas, even land use descriptors were different depending on whether you took them from Ministry of Environment or Ministry of Food and Agriculture. So we had these were significant data challenges. Having said that, and having clearly stated our assumptions as to which one are we choosing and why, giving a clear case that, we prefer this one because ABC, these are the reasons, and we will not use the other one. So we gave those clear statements and then produced these 6 monographs. And this is a table whose main purpose is to point out to you that there is a lot of knowledge hidden sometimes in the way results are reported, because people are not reporting stock changes and flow changes separately, and they really must. And I apologize for the numbers are not looking very, very easy to read from a distance, but I'll read them to you. So if we look at one state, Himachal Pradesh, which is a northern state in India, we'll find that there was, for instance, when we come to measuring timber and fuel wood, the net change, the net adjusted GDP impact would only be about 3%, but that disguises a massive increase in value due to gathering of deodar trees. This is a particularly high-value timber by the local population that was permitted in those days. And we actually went down to do ground truthing in this state because we thought these numbers were suspicious. So we actually had to go and check out what was going on. We found this is true. There's a massive value addition that is taking place because of the use of and sale of these deodar trees. Misuse because it was not meant for commercial, but it was actually meant for construction and personal use. But at the same time, there was a massive drop in stock. So the biomass value of the forest was declining. We couldn't figure out why. This was the reason. There was something called the TDS, the Tree Distribution Scheme. But anyway, you can see the numbers. If we had netted, then we would have ended up with an innocuous change of 4% and ignored it. But because we didn't net, we could see that there's something going on here which we need to understand. So hence the importance, just an example of not netting and presenting flow changes separately and stock changes separately, flow adjustments and stock adjustments. You can see that even in some states, there are different values of forest, but if we look, for instance, at the state of Assam, in the northeast of India, then we will find, for instance, the ecological services, there is a benefit, an unstated benefit of 2.5%, but because of the loss of forests, there is a capital loss, a natural capital loss of 6.8% in the year. These are percentages of state GDP. So these are very significant numbers in economic terms, in terms of the value that is being either created or destroyed as a result of actions of the forest policy. So there's a lot of learning here, and if I were to try and summarize what we learned from this and what I learned from this, probably 6 things actually. One is that we just have to manage with imperfect data. I mean, I've seen exercises and helped people in Indonesia, Vietnam, and many other places, and the story, and Colombia, there are different variations of the same story. There are data challenges absolutely everywhere. So please do not for a second feel that, it is only Sri Lanka that we have these problems. That is not the case. Everyone has these problems. And we just have to manage. And 3 dimensions. One is there's an availability challenge, there's a quality challenge, and then there's a diversity challenge, because very often you just cannot rely on any one source or one department for the data that you need to prepare your green account. So we just have our experiences that just take whatever you think is best, but clearly state your assumptions and explain why you have chosen that. And that's my second learning, was that we must deliver transparency. Even if you have to give something as mundane as a spreadsheet at the end of the day, with clear assumptions, please do that. Don't give them a black box, because policymakers don't like it, central bankers don't like it, and the results will not get used unless you have that transparency. Third lesson was to seek comparability. What do I mean by that? So one of the challenges with large countries which have engaged in green accounting, like USA, India, through our project, and China, which is still going on, is that if you work at the national level, because it's so big, it's everybody's problem, and therefore it's nobody's problem. So to get any practical change happening and focus and attention on any particular issue that has arisen through your green accounts, you need to work at one level below. Now, of course, I'm talking about very large countries here. So that is one important thing. And then when you do that, another advantage that you work with is that you're making comparisons. So yes, if you have a data challenge in province A, then the same applies in province B. So at least you're comparing like with like. It's not as if you're presenting a distorted view, because you've actually filtered out some of the challenges of data by talking in terms of comparisons rather than talking in terms of absolute numbers. So there is an advantage actually in trying to seek comparability, as I say. The fourth, and I should probably have put that number 1, actually, if I think about it, is to seek policy relevance. Because unless your analysis is answering a particular policy question, it may not ever get used. And one of the ways of making it policy relevant is to either pick sectors like freshwater, which is an issue in almost any developing country in Asia, or pick either pick a sector like freshwater or pick an issue like the GDP of the rural poor. Now, we know that there's a huge nature dependence on the GDP of the rural poor. How to establish that? I think green accounting can help us do that. So if we pick that, then people will listen, because this is for the poor, it is important, it is a large part of their livelihoods. No politician will ignore that, and it's important to pick these issues. The fifth learning was simultaneously engage inclusive wealth metrics, which are simpler, and yes, they make more modeling assumptions, and now they're being done officially by the United Nations University, so actually there is some help available in doing so, and UNEP has also joined forces with them, so there is capacity. So capacity building is already happening. The negative side of this is that people don't understand. When you talk to the press and you say inclusive wealth as a central banker or as a statistician, they have no idea what you're talking about. You'll have to spend a few minutes explaining what is this. But they'll understand eventually. And even when I find people, making statements about GDP, sometimes I cannot suppress a smile because, they haven't really understood how it works, but they think they know. So sometimes that's an advantage. If someone thinks they know GDP and you're saying, no, but actually my adjustment is 4% or 8%, you've made a point because it's versus her or his understanding of that reference. But I think the challenge, the opportunity here is to let's move to the next stage, get people to think they understand inclusive wealth, and then we can make even more important and easy to communicate statements using inclusive wealth. And my last point, and some of you who are, with apologies to economists like myself, that there are many macroeconomists and many financial economists, but there are very few national accountants. So when you are building teams, when you have got projects to do, it's really important to not assume that just because someone has a great degree in economics, that she or he will immediately be the best person to do a national accounting project, because these are different skills and attitudes. So I learned the hard way, as you can see, so just merely sharing that in total honesty, that it is important to try and find, if not develop, some of the national accounting skill that is required, and even the interest, but it's not everybody's cup of tea. We have the SEEA, which is now moving on through the 2013, and I think this is where all countries are. I think there's something like 35, 36 countries which have developed countries and 24, 25 developing countries who have started. These are just some quick notes on SEA, but you're all aware of this. I mean, we have a few key points. It's a framework to compile and link environmental statistics and economic statistics. It is a satellite system of the SNA. There are three elements to the satellite. There's a central framework, and there's the ecosystem accounting framework, and then there are the subsystems which focus on particular sectors like fisheries or freshwater or energy and so on. And it doesn't, thankfully, hinge on a single indicator like GDP. So it's looking to present things more holistically. And of course, it has many uses. Very flexible, it's very flexibly designed in terms of every country's SEA result doesn't have to look like another country, but it's using the same principles. So far, what has been happening is that most of the work in terms of SEA-based applications are in the area of air emissions, that is pollutions, air pollution, material flows, and energy. Energy, and therefore its carbon footprint. And as I mentioned, there's more than 34, I think, developed countries, about 24, 25 developing countries, another 10, 12 developing countries planning to go this way. So this is moving forward. And people in the developed world are focusing more on energy. And I guess in the developing countries, there's quite a lot of talk on what to subsidize and what environmental taxes to apply. A related initiative is WAVES. Some countries are involved in WAVES, and this is basically World Bank-led, and I guess right now we are seeing more of the VES than the WA part of WAVES, because we are seeing more of valuation of ecosystem services and not that much of wealth accounting. But it will get there. It is a good initiative. It's been well supported by many developed countries, including Norway, USA, UK, and so on. Its objectives are to help countries to adopt and implement accounts relevant for policies. So in that sense, there's a crossover between WAVES and SEEA, TEEB and SEEA, TEEB and WAVES. These are all connected initiatives. And it develops approaches to ecosystem accounting. And they do invest in, and this is where opportunities are there, in capacity building. And they have done so in the case of Botswana, Colombia, Costa Rica, Madagascar, and the Philippines already. And more recently, Guatemala and Indonesia and Rwanda have joined the initiative. I'll close with a thought about a consistency between our world and the world of the private sector. So, friends, as you know, the private sector accounts for about 2/3 of gross value-added GDP and about 2/3 of jobs. So they are pretty important, no matter which way we look at it. We cannot have a change in macroeconomic policy without roping in the micro level, without roping in the private sector. Sustainability is all about economic direction and resource use. And it is the resource use of the private sector that is actually pointing us in the direction that we are going. So with all the goodwill in the world, and I know you have it, and with all the right intentions, how will you succeed unless you have created a mirror image of your thinking in the world of the private sector? Yes, you can adjust the accounts of society, but how will you adjust the accounts of the corporation? So this has been a lot of drawing a lot of my time and energy for the last 2-3 years. And I just want to share with you a common framework that many of us in the world in this space have decided to adopt. And when I say many of us, I'm including leading consultancies like TrueCost in London and TruePrice in Amsterdam and Just Advisory, that's my own firm in Switzerland and India. We follow the same approach, as you can see, that is there in the inclusive wealth and the green accounting framework. We look at physical capital, human capital, and natural capital. We first look at the public goods, in other words, aspects of public assets in all these spaces, and we recognize social capital in terms of constitutions, judiciaries, law and order, tax systems, and the softer aspects such as social equity, communal harmony, cultural diversity, and so on. These are all part of the landscape of capitals that we need to measure and value. But we also point out that whilst this is public goods, and of course most of what is missing in national accounts or missing in wealth to make it inclusive wealth is the public goods category, but actually also what is missing in the way we manage is other layers of ownership of capital. Wealth is sometimes owned in public hands, but it's also sometimes owned by communities collectively, right? And these are important: community centers, community schools, physical capital, traditional community knowledge amongst your tribal and village communities. And then there are community forests and common grazing grounds, natural capital. And of course, there are community rules and norms. So there is a whole world of capital which is mirroring this structure of three capitals and enabling capital, also at the community level. And then finally, and perhaps most significantly, is the same structure is there even at the private sector level in terms of the world of markets. So things like factories, securities, software, patents, licenses, these are physical capital which are owned by companies, can be sold for cash, converted for cash, and vice versa. They also provide good health and education and skills to their employees. And of course, if they're in certain businesses like mining or agriculture or forestry, they might own private forests and fields and mines and so on. And then, of course, there's markets. Markets also have huge social capital. If they don't, they fail. Design of markets, regulations, rules, even etiquettes amongst market makers, and civil and criminal laws to enforce contracts, and of course, judicial systems to make sure they are properly done. So we have these dimensions of wealth, which you are already seeing in terms of green accounting and inclusive wealth. These are reflected all the way down in our frameworks, what we are describing right now, to the private sector. And the point that all of us, that is TrueCost, TruePrice, GIST, and others are making to the private sector is that please, your actions impact all categories. So please don't think that it is sufficient for you, as you do today, to only measure and report the bottom left-hand corner. Because, ladies and gentlemen, today's accounting systems for the private sector only require shareholder reporting. They don't require stakeholder reporting. They only require you to draw up the balance sheet of the company and its profit and loss during the year, which is shareholder wealth. But of course, if you look at this final slide that I have for you, actually, a company can help build a community center. It can do bioprospecting and make use of traditional community knowledge if it's a pharmaceutical company. It can either take over, destroy, or help conserve a grazing common or a community forest. It can definitely fish in international waters and high seas. It can definitely help or hinder the policy of a national park. It can create public databases like Tesla has created by putting its battery technology on the web. It can make use of non-patent knowledge. It can obviously be constructing a road or a bridge for the government. So a private sector corporation is actually not only involved in the bottom left-hand corner, it is involved in each and every box that I have drawn out here. And yet, our systems only ask them to report on the bottom left-hand corner box, which is the balance sheet and the profit and loss. So I request your help that this afternoon session, which is targeted at the private sector, and I will be repeating this message there, please help them and encourage them to make sure that the good work that you are all focused on at the macro level is also reflected at the micro level. Thank you very much.
Thank you, Mr. Sukhdev. Now, I would like to kindly invite the Governor of the Central Bank of Sri Lanka, Dr. Indrajit Kumaraswamy, to address the gathering.
Mr. Pavan Sukhdev, UN Goodwill Ambassador, Mr. Anu Disnaka, Secretary Ministry of Mahavali Development and Environment, Dr. Satara Singh, Director General, Census and Statistics Department, secretaries to ministries, my colleague deputy governors and assistant governors, ladies and gentlemen. This is really, there's a saying, I think Old English saying about what comes after the Lord Mayor's show. After that masterly presentation by Mr. Sukhdev, what you're going to hear from me is going to be very pedestrian indeed. But let me thank Mr. Sukhdev for taking time off his very busy schedule to share his considerable experience and expertise with us. Because I think it's fair to say that the process we have started in this area has run into some speed bumps which we need to overcome, and I hope that this interaction that his visit has stimulated will help us to gather momentum, to infuse a momentum into a process which has perhaps slowed down more than we wished it had done. Let me also thank the Ministry of Mahavali Development and the Environment, the Census and Statistics Department, IPS and other stakeholders who have helped the central bank to organize this event. Our role has been that of a facilitator and to play a catalytic role in helping this process to move forward. I must say that, clearly in terms of mandates, the fact that Sri Lanka has signed up to the SDGs and the Paris Declaration makes really sustainability a key component of our national agenda. And one really can't make significant progress in mainstreaming sustainability into our budgeting, our planning, and our overall policy making unless we have a robust database to do so. And clearly, the SEEA is the foundation for establishing such a database. So that's really the logic of giving priority to this work. And I was also intrigued by Mr. Sukhdev's suggestion that we come at this problem through the concept of inclusive wealth, because that's certainly something that would immediately grab the attention of many people around the world, really. As we all know, increasing inequality is arguably the most significant problem that the world faces today. I remember the Asian Development Bank, in its flagship publication a few years ago, identified increasing inequality as the main threat to the 21st century becoming the Asian century. And we've seen the rise of extremism around the world, protectionism, xenophobia, all kinds of negative forces generated even in the most advanced countries. And I think the lack of inclusivity, increasing inequality are clearly major causal factors in the gathering of momentum of these negative forces. So looking at the problem through the prism of inclusive wealth, I think would certainly be a good way of drawing attention to a lot of the issues that Mr. Sukhdev then went on to cover. Now, the old Brundtland report, which probably started, not really started interest in this process, because as Mr. Sukhdev has pointed out, there was work that was done prior to that, but probably the popular international attention was drawn to these issues through the Brundtland report, and it defines the concept of sustainable development as development that meets the needs of the present without compromising the ability of future generations to meet their own needs. And Ban Ki-moon, the former UN Secretary General, stated that sustainable development is the pathway to the future we want for all. It offers a framework to generate economic growth, achieve social justice, exercise environmental stewardship, and strengthen governance. Clearly, these are all noble objectives which underpin this concept of sustainable development. From a more practical and urgent point of view, the increase in the frequency and intensity of natural disasters, which can be attributed at least in part, if not in large measure, to lopsided development of one pillar over the other, means that we need to heighten the attention we pay to these issues. For the need to consider economic as well as environmental accounting in assessing the economic performance of a country. As you know, the UN system of national accounts disregards the impact of economic activity on the environment. We've heard that from both our speakers. It does not assess the damages and losses inflicted by economic activities on the environment, nor the depletion of the natural resource base. And environmental economic accounting should therefore be a complement to the traditional national accounting practices. The main objective of integrated accounting is to support the coherence of social, economic, and environmental policies by means of adjusting indicators such as national wealth, net domestic product, consumption, and capital formation for their environmental impact. With the use of these national level estimates, the policymakers would have measurable data which help to identify the composition of wealth of the nation, the effects of economic activity on the environment, the impact of the depletion of natural resources on the income-generating capacity of the country, and also to monitor interactions between these trends. They also provide a database for strategic planning and policy analysis to identify more sustainable paths of development. Therefore, the establishment of a green accounting system in Sri Lanka needs to be considered a system that would bring far-reaching benefits for the country. It would also pave the way to work towards achieving the Sustainable Development Goals, where Sri Lanka has committed itself as a counterparty to the Convention itself. It would also help to track our commitments made under the Paris Declaration. So I can say a little bit about country experiences. Regardless of their position on the whole spectrum of development experience, many countries have taken steps to implement the SEA framework, from very advanced countries to relatively less advanced countries. They've all made a start in terms of implementing the SEA. However, there has been less success in mainstreaming green issues into the policymaking process. And the lack of a robust database has been a major contributory factor in this. Without having a good system of economic and environmental accounting, it becomes much more difficult to mainstream sustainability into your core policymaking processes. One tends to have this as an add-on rather than being part of the mainstream of policymaking. In Sri Lanka, the compilation of official national accounts is carried out, as we know, by the Departments of Census and Statistics, based on SNA 2008. Despite the persistent methodological and practical challenges that continue, there are strong grounds for capturing the overall economy. This reinforces the merits of embarking on the preparation of SEAs. This would be a daunting task, but one from which we cannot afford to shy away. I think one of the messages that Mr. Sukhdev provided for us was the significant changes that you see once you introduce the environmental dimension into the national accounts process. So clearly, you know, we've been making policy in the dark to a significant extent. And the other issue, and going back to the theme of inequality that I started with, I suspect if one does an SEA, given the disproportionate impact of environmental impacts, such as the depletion of natural resources on the poor and vulnerable, I suspect inequality in our countries is probably even more severe than we currently know. So there's again a compelling reason for developing this framework. Now, as I said, a number of countries have embarked on introducing the SEA. The benefits they anticipate arise from building their capacity to focus on the sustainability of their environmentally adjusted asset space. By doing so, they're protecting the long-run prosperity and welfare of their societies. They're attaching priority to the intergenerational transfer of the legacy of their resource bases, which will ultimately determine the opportunities for future prosperity. This, in turn, will have a bearing on the social and political stability of their societies in the future. Sri Lanka has also taken steps under the Ministry of Environment, Mahawali Development and Environment to incorporate the environmental dimension into the decision-making processes of our country. Mr. Dissanayake has pointed out we have a national steering committee on the establishment of a green accounting mechanism in Sri Lanka, which was established in 2010, which is actively driving the process, and it comprises members from key national agencies. Even prior to that, in 2008, several discussions and brainstorming sessions were conducted by the Ministry of Environment and the IPS, which resulted in an assessment of the then situation for establishing a green accounting mechanism for the country, and a roadmap was prepared at that time. As Mr. Dissanayake also pointed out, Sri Lanka has already made significant progress by estimating the total economic value of the forestry sector of the country, and several working groups have been established covering key areas of the country's natural endowment. However, as you all know much better than I do in this room, the progress of this work has been constrained due to a number of obstacles, such as the lack of reliable data and information, the lack of resources, and the lack of a well-defined official mandate. In this context, the rationale for this national workshop on green accounting, which commences today, is to lay a strong platform to build the necessary framework for establishing a green accounting system for Sri Lanka. I hope the technical sessions which would enable us to identify the necessary guidelines for advancing this agenda. This would be timely. We have just had 3 consecutive cultivation seasons which have been affected by drought. We have experienced floods in 2016 and 17. Environmental and disaster management issues need to rise to the top of our national priorities. So I hope today's proceedings will be a landmark in our journey to compile robust, environmentally adjusted national accounts. Without this, policy making will be severely constrained. Now, in conclusion, establishing a green accounting system in a country is a serious undertaking that needs resources, knowledge, technical skills, and institutional cooperation. The key stakeholders represented in the National Steering Committee are spearheaded by the Ministry of Mahawali Development and Environment. In addition, the Department of Census and Statistics is a key player. They have the mandate to produce the national accounts of the country and possess a wealth of technical expertise and experience. Nothing will be possible without tapping into that resource base. Today, we also have the opportunity to harness the vast experience and knowledge of the UN Goodwill Ambassador, Dr. Pawan Sukhdev, to give impetus to the entire process of greening the national accounts. We need to get the entire process on the right track within a reasonable timeline. So let me conclude by wishing the National Committee and all other stakeholders every success in this national endeavor. We in the Central Bank can commit ourselves to be facilitators and advisors in this important process. Thank you all very much.
Thank you, Governor. With those empowering words, now I'm pleased to invite Mr. Chris Dharmakirti, Country Head, Blue-Green Economy Finance Facility, to deliver concluding remarks.
Good morning. Thank you very much, Governor, for those very encouraging words. Let me first thank Pawan Sukhdev for coming over to Sri Lanka at very short notice and making sure that he can give a revamped start, and Secretary to the Minister of Environment for giving the leadership in terms of giving a commitment that he will get the National Steering Committee to move forward. So I'm very happy that we have the country representative head for the United Nations here with us, and also the UNOPS head here, who has been providing the facilitation for the creation of the Blue-Green Economy Finance Facility that was established. Thanks to Mr. Satya Tripathi, who is the global lead on sustainability at the United Nations Environment Program, who's also come down from Nairobi to give his blessings to this very important initiative today. And of course, I think on behalf of the Blue-Green Economy Finance Facility, which has been exclusively established to create a partnership with international partners, finance partners, it is my privilege this morning to offer the closing remarks for this inaugural session. It was heartening to hear this morning that from both the Secretary, Mr. Anurag Disanak, and also from the Governor of the Central Bank, Dr. Indrajit Kumaraswamy, that Sri Lanka has started the process way back in 2008 and is going to build its internal capacity to implement the Green Accounting Reporting Framework as quickly as one can. Although it is not an easy task to accomplish that task, Sri Lanka's commitment to get it done is reflected in the fact that policymakers have established a National Steering Committee on Green Accounting with the Minister of Environment chairing it, and now all of the relevant stakeholder sector ministries being the ex-officio members of this committee. We at UNEP recognize the value of this ongoing national initiative and thus offered our technical support to the Governor of the Central Bank and to the Secretary of the Ministry of Environment that we can get the visiting unit expert to come here and help steer this particular workshop in the direction that it should take. So I would like to thank Dr. Pawan Sukhdev for being here and for making his time available to Sri Lanka. Also, some of you already know that the Blue-Green Economy Finance Facility was established this month to enable and facilitate for Sri Lanka to tap $24 trillion in global funds that is filtered through the lens of sustainability. And I know there are lots of different initiatives that are being initiated in the Governor of the Central Bank in June this year, brought together the financing institutions from around the world with IFC leading it to look at the possibilities of tapping those funds. And clearly, we too would be providing assistance to the extent that we can to enable Sri Lanka to tap those funds. So in order to attract that quantum of capital, Sri Lanka needs to get some prerequisite initiatives, like the green accounting, reflected in the national accounts, with several other crucial policy commitments, as measuring the effect of human activity on the environment has emerged as an important policy issue. On the one hand, there's a growing concern about the effect of economic activity upon the local and global environment. And on the other hand, continued economic growth and human welfare are dependent upon the benefits obtained from the environment. In recent years, Sri Lanka has demonstrated its understanding of this interrelationship by declaring policies that are focused more and more on how the national economy can be developed in a sustainable direction, with a particular focus on mitigation and adaptation of climate change as well. Environmental accounts, as we all know, are well placed to support coherent analytical and policy framework to inform debates, guide policy, and to have the interrelationship between the economy and the environment firmly established. As an accounting system, they enable the organization of information into tables and accounts in an integrated and conceptually coherent manner. This information, of course, can be used to create coherent indicators, to be used to inform decision makers, and to generate accounts and aggregates for a wide variety of purposes. Given this multidisciplinary scope, the environmental accounts can be used for policy development as well as evaluation of decision making in a number of different ways. Firstly, the summary information provided in the form of aggregates and indicators can be applied to issues and areas of the environment which are the focus of decision makers. Secondly, the detailed information, which covers some of the key drivers of change in the environment, can be used to provide a richer understanding of the policy issues. Thirdly, the environmental accounts data can be used in models and scenarios designed to assess the national and international economic and environmental effects of different policy scenarios within a country, between neighboring countries, and at a global level. It is our hope that the deliberations this afternoon and this morning and tomorrow would take place in this chamber, that the policy planners and officials involved in this workshop would identify a way forward to create a resource-efficient, low-carbon economy to achieve sustainable growth for Sri Lanka. We hope that Sri Lanka would be able to, in the future, be equipped to monitor resource productivity derived from environmental accounts with a dashboard of indicators. Sri Lanka, with its recycling and reuse cultural habits of the past, is well placed to also robustly implement a circular economy that promotes a fundamental transition where resources are not simply extracted or used and discarded, but put back into the loop so that we can stay in use for longer. This calls for new waste targets and investments in waste management technologies. And substantial international financing facilities are available to achieve those. With data on growth and employment from the environmental accounts, particularly the environmental goods and services sector accounts, Sri Lanka would also be well placed to create a new green jobs and monitor its growth. Please note that within the ambit of green accounting, it's included a large accounting changes in natural capital and human capital, both of which are essential for sustainable development. Sri Lanka would also be able to ensure that her macroeconomic policies are sustainable, not only economically and socially, but also environmentally. The empirical data on or secondary sources on the potential economic and social benefits of environmental fiscal reform would be a welcome addition to the policymakers. The macroeconomic arguments for shifting and mobilizing investments at an economy-wide level towards the green sectors and to the greening of brown sectors would be another benefit when green accounting is implemented. As you would now realize, there are multiple reasons and very good economic reasons to implement green accounting, and we at UNEP is very happy to have had the opportunity to assist Sri Lanka in this ongoing initiative, and we will do whatever we can in the future to facilitate it. So in the next 2 days, we hope that you will bring your vacuum cleaners to vacuum Mr. Pawan Sukhdev's mine, and he has offered a free vacuum cleaning car to everyone. He says, I hope people will take as much as possible out of my mine. We'll have so much to share. And it's only 2 days that I'm here. So Chris, please ask everyone to ask me whatever they need to know, and I'll do the best I can. So I want you to know that Pawan is very generous with his offer, and please make use of him during the next 2 days, both not just at the sessions, but when you meet him in the sidelines at lunch or tea breaks. So with those words, I'd like to thank the Governor of the Central Bank for accepting our offer to provide Mr. Sukhdev's inputs, and also the Secretary of the Ministry of Environment for offering his wholehearted support for this initiative, and also the Director General of the Census and Statistics Department, who is very aware of the challenges it takes to get this done. And I think, as he quite correctly pointed out to us during our meeting, that it needs a measured and a planned approach to do this with proper timing and facilitation to do that. So I hope that will be achieved. Thank you very much.
Got to rectify a major omission on my part, and that is I should have expressed our thanks to Chris, Dr. Chris Dharmakirti, who really was a kind of a one-man band in cajoling and pressing us into getting this event together. So thank you very much. This is really very much an outcome that owes a great deal to him. Thank you.
Thank you, Governor, and thank you, Mr. Dharmakirti. With that note, we have come to the end of the plenary inaugural session. We would like to invite the participants and the delegates to join us for tea, which is served in the lobby area next to the conference hall. And please note, the technical sessions will resume at 11 a.m. Thank you, everyone.